Here's something most people get completely wrong about investing. They think watching their account drop from $400,000 to $320,000 in the market means they lost $80,000. They didn't. Well, not yet anyway. See, there's actually only one way to truly lose money in the stock market, and most people do it to themselves, and usually at the worst possible time. I'm Terry O'Grady, a certified financial planner, and in this video, I'm going to walk you through how market losses actually work, why what you see on your screen isn't always real, and the one move that turns a temporary dip into a permanent loss. This is general education. It's not personalized advice because I don't know you, at least not yet, and maybe you're only getting to know me a little bit. Yeah, we haven't met yet, but it just might save you from making the most expensive mistake in investing. All right, we're going to start with a term, and you've got to understand this. It's called paper loss. And I don't mean the guy who used to drop the Wall Street Journal on the driveway every morning. Then it started coming in the mail, but our mail comes in the afternoon around these parts, and what good is the Wall Street Journal in the afternoon when the market opens at 9:30 in the morning? So, yeah, that to me is a paper loss. But what we're talking about in this context is when the market goes down and your account balance drops, that is a paper loss. It exists only on a screen. It's real in the sense that if you sold everything right now, well, you would get less than you paid. But you haven't sold, have you? Which means you haven't lost anything. Think of it this way. Say you bought a house back in the early 2000s. Well, let's say 2006, and it cost $350,000. But by 2009, Zillow was saying it's only worth $210,000. Whew, that hurts thinking about. Did you really lose $140,000 though? Well, only if you sold it in 2009. If you held on, if you just kept living there, the price eventually came back. And for most people in most markets, it came back and then some. Your investment portfolio works the same way. So what's the only way you actually permanently lose money in the stock market? Yeah, you know, you sell. That's it. When you sell investments for less than you paid for them, the loss becomes real. It's what's called a realized loss. And yeah, then you realize maybe you did make a mistake because you've locked it in. The money really is gone now. And here's the brutal part. People almost always sell at exactly the wrong time. The market drops 20%. They panic. Their stomach drops. They can't sleep at night, so they pick up the phone and say, Terry, I can't take it anymore. And they sell. Or they log into their online investment account and do it to themselves. Yeah, self-inflicted. And then guess what happens? The market recovers and they've permanently locked in a loss that would have healed on its own if they just stopped picking the scab, if they just waited. And then guess what happens next? Yeah, the boys down at the weekend barbecue start talking about the market, and the business channels can't stop talking about it either. About the market rally, the new bull market. USA Today can't help but put it in their headlines, and FOMO hits, fear of missing out, because at next week's get-together, they don't want to be the guy who's not in the market. So what do? They buy the exact same things they used to own, but this time at a higher price. They sold low and bought high. Just the opposite of what Grandpa Joe used to tell them. Buy low, sell high, sonny boy. I've been doing this work a long time, and the biggest losses I've seen weren't caused by the market. They were self-inflicted. They were caused by the decision to get out of the market at the worst possible time. So why do people do this? Otherwise, smart people, why do they make this mistake? Well, because it doesn't feel like a mistake in the moment. It feels like it's the right thing to do. When the market's dropping and the business channels are screaming and the news is scary and your neighbors are talking about how bad things are and how expensive things are down at even Aldi or Publix, selling feels responsible. It feels like you're taking control. But there's something called loss aversion, and research shows that the pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. So a $10,000 drop in your account feels way worse than a $10,000 gain feels. Yeah, sonny boy, think about those trips to Vegas. Didn't losing $1,000 at the slots feel way worse than picking up $1,000 at the blackjack table? Yeah, that pain is real. But acting on it, especially by selling, usually makes things worse. The market has dropped dramatically many times. You got to remember that. Remember the tech bubble back in 2001? Well, if you're old enough, you might remember that. Or how about 2008, the financial crisis, or even 2020, the corona crisis? Every single time, it eventually recovered. Every single time. The people who sold at the bottom locked in losses that didn't have to happen. Now, let's be fair. There is a situation where a market drop can really hurt you, even if you don't sell. It's called sequence of returns risk. And it matters most for people who are already retired and taking money out of their portfolio. And here's why. Let's say the market drops 30% in their first year of retirement, and they're pulling out $50,000 a year to live on. Well, then you're selling shares at depressed prices when the values are down. You're eating into principal when it's at its lowest, and that can permanently shrink your portfolio in a way that can be hard to recover from. So this is exactly why how you structure your income in retirement matters so much. Let's say you have a Social Security, a pension, or maybe some short-term cash reserves to draw from to get you through those downturns. Then you don't have to sell your investments when they're down. You just ride it out. If you don't have that cushion, though, that's something worth talking through with a financial planner. Because the goal is to make sure a bad market year doesn't force your hand. Oh, see what I did there? Little Vegas, show me your hand? Okay. All right, we're going to bring this horse back to the barn. Paper losses aren't really losses. They're just on paper. Your account dropping on the screen doesn't mean you've lost anything as long as you don't lock it in by selling. The only way to truly lose money in the stock market is to sell below what you paid. And the most reliable way to avoid that? Have a plan. Have a plan before the market drops. Know where your income is coming from. Know why your portfolio is built the way it is, so that when things get scary, and yep, they're going to get scary at times, you don't have to make decisions from a place of fear. And that, my friends, is what retirement planning is really all about. If this was helpful, why not subscribe? We can spread the love and spread the information. And hey, I've got a free checklist on the things to think about during a market correction or a recession. There's a link in the description below. In the meantime, I'll see you right back here in the next episode.